Nothing like talking about accounting right before the lunch break. So thank you all for showing up and sticking around. Quick overview on Propeller. We were founded about 17 years ago as a full stack CFO down to staff accounting solution for VC-backed startups. Basically, from seed to Series C, founding teams should be focused on building, selling, and scaling, not necessarily having a perfect instance of QuickBooks. And while it's important to have a CFO around, there's just not 40 hours a week, definitely not at the seed and Series A level. I joined the firm about 6.5 years ago, and kind of very much by chance got handed Solana Labs as a client. I was new to the space and nobody really knew what to do with them as a client, but I raised my hand and wondered what could go wrong here. Very quickly realized that in addition to the finance and accounting work we're doing for all of our other clients, there's going to be the second layer of crypto finance and crypto accounting. How do you take on-chain activity and translate that to the P&L? And as I came to discover, the intricacies of balance sheet reporting per US GAAP it's non-trivial, and I think that's, for the most part, what we'll be talking about today. A little bit of background on balance sheet reporting for digital assets. In the very beginning, they were defined as indefinite-lived intangible assets, which meant that they could only be marked down, they could never be marked up. There was a FASB ASU that rolled out last year, which had some improvements, which allowed some fair value reporting of certain digital assets, which is great, but it wasn't comprehensive. It was a step in the right direction. You still had to be recording at book less impaired for NFTs, native tokens, and wrap tokens under some circumstances. And this creates a bit of a headache. You think about what a purpose of a balance sheet is in the course of a business. It represents what you own, your assets, what you owe your liabilities, and what's been invested in you, your equity. Basically, for any business that's carrying digital assets on the balance sheet, it's kind of fundamentally broken if you have to be reporting some digital assets at book value and others at fair market value. Additionally, and we'll get into this in a bit, you don't really see what you actually own to just look at a balance sheet. So these are kind of the hard questions that I think we've faced as a firm, and I think other accountants and professionals in the field are constantly grappling with. There is another theory, and I think this is also very relevant to especially RWAs, but it's substance over form. And this basically says that forget about all the FASB stuff and the intangible rules. You should be taking a look at what is the thing, what is the underlying asset that you're tokenizing, and that should be the guiding principle. I realize I've just said a few things that are totally contradictory, and there's two words that I absolutely hate when it comes to accounting and when you ask accountants questions about specific treatments, and they are, it depends. And so you have to look at the facts and circumstances across the board. I think that also, a key theme that I think makes accounting really, really important for RWAs and digital assets in general is that if you can't account for it, you're not going to be able to transact with it. Digging in a little bit more to character matters, this is really, you want to unpack kind of what is the underlying asset, and is it tangible, is it intangible, is it real estate, is it a current asset or long-term, can you turn it into cash easily, is it capital, ordinary, investment asset? Again, these are all the considerations that go into trying to figure out what is the thing. And I think taking a step back from really describing not only how you account for it, whether it's book value, fair market value, it also is not very clear where exactly on the balance sheet a tokenized asset belongs. And I think what's really important, and I think everybody who is either has a RWA project or is, has a passion for the space, if your CFO is not comfortable putting digital assets on the balance sheet, you're going to have a really hard time getting movement for digital assets. And so, where do digital assets belong? Stable coins are not cash. We saw Circle depeg last year. It does not belong in the top with your other bank accounts. Are tokenized treasuries investments? Sometimes. It really depends on what the thing is. And then getting into great presentation on real estate, but if don't really know a use case for a business to put fractionalized art on the balance sheet, but there are a variety of different types of things that will appear in different places on the balance sheet. So we just covered these things can be valued at book value or fair market value, and there's an impairment test if it's book value. You don't know exactly where it belongs on the balance sheet, and it gets even more complicated. What happens when the thing isn't the thing anymore? To quote Melton from yesterday, if you're just tokenizing shit, it's pretty easy. It is what it is. But we're lucky enough to be working in an industry where there are really exciting primitives that can be done with tokens, tokenized RWAs, and that includes making them programmable, composable, fractionalizing. And everything I just said leading up to this can throw all of that out the window. It doesn't matter what the underlying thing is if you begin to program it and all of a sudden the thing is not the thing anymore. And sorry, unfortunately this goes also back to those two words that I absolutely can't stand when you're trying to figure out how to account for it. It depends. Getting into I think I brought up a bunch of hard questions and challenges that accountants face when trying to take tokenized RWAs and other digital assets and putting them on the balance sheet. And I'm sorry for bringing more questions. I do have at least a suggestion of an answer behind me here. And while you might have an assortment of tokenized assets, tokenized RWAs, I'm not going to try to explain the edge cases, but I would like to share with you a best practice for actually reporting. And what we really have developed is a bridge between what you report per US GAAP and what you think about when you think about the digital assets in an entity's portfolio. And we call it the Statement of Digital Assets. This was born out of really the need of trying to make sense of what we were reporting on the balance sheet when it was just the lower of cost or impaired value. And then we realized that our clients don't really think about things in US GAAP. They think about what is the fair market value, what is the treasury. And so it just made sense for us to begin to obviously report the three statement financials on a monthly basis, but then begin to think about how do we really provide visibility to our clients when we talk about the world through a US GAAP lens, but then be able to show the numbers that they care about and the framework and the wallets and the assets and the quantities that just keep them awake at night. This was an early iteration of it. I think that where we have brought this, again, this was something that we developed at Propeller, and for, I think, a hot second, I thought we had something really proprietary and clever. The reality of it is, it is just a logical approach to a problem that I think many businesses were facing. And as we started to really dig into it, we realized that there were applications beyond just operational accounting. It went to audit, to tax preparedness, to regulatory reporting. And ultimately, we started talking to our friends in the industry, and instead of trying to say this is our kind of walled garden idea of a reporting schedule, we decided to collaborate, and we came out with a white paper that just got updated about a month ago. We had contributions from A16Z, Delphi Ventures, EY, OP Labs, Masari, a bunch of others that you've heard of, a bunch of others that you haven't. And really our goal right now is to create a standard that can be a reporting tool for digital assets that will easily tie it to US GAAP, and basically allow people who are wanting to engage with a variety of tokenized RWAs, engage with the, call it the digitally native ETHs and Bitcoins, and really be able to make sense of that through a GAAP lens. So we have a white paper. It is downloadable at sodafinance.xyz. We are also in the process of eliciting endorsements. This is not a Propeller project. This is a public benefit collaboration with some of the firms that I mentioned, along with others. But happy to talk about Soda, happy to talk about other challenges when it comes to accounting. And I would love to get into edge cases, but I guess would love to open this up for Q&A, and we'll answer what I can.
All right, raise your hand if you have a question, and I'll come to you with the microphone. If not, I have a question. All right, my question. You mentioned the part about stablecoins not equaling cash. Do you see a world in which like regulatory clarity or legislative clarity comes about where, I don't know, that can unlock stablecoins at scale in a meaningful way?
Yeah, well, so I think there's been a lot of rumblings about stablecoin legislation. And I'll look to the other accountants in the room. I think that this is something that we would love to get clarity on. When we report to our clients, we don't group stablecoins in with all the rest of their digital assets, because when you're looking at a balance sheet, and if you are, well, any kind of a project, especially a startup, the most important questions that you might have are, what's my runway? How many months do I have until I run out of cash? And from an operational perspective, stablecoins look like cash, they act like cash, and you know, without diving too much into the SVB fiasco from a year and a half ago, they are pretty much cash. So it just don't put it in the cash section of the balance sheet.
All right, we got a question over here.
Less of a question and more of something I think you should address, Sam. Just by way of full disclosure, we're sometimes competitors. I work at Eisenramper. I think one of the things that a lot of founders don't think about until they're too far down the road and it becomes very expensive to unwind is the importance of getting this right on the front end. And I think maybe you want to say a few words around that, because you and I have both seen that.
Yeah, no, that's a great point, and there's a funny funny truism, especially if you've got your own token. You might have $1 billion worth of value of your native token, but if you spun it up and it's sitting on your balance sheet, it's sitting on your balance sheet at almost a zero cost basis. So number one, you're not showing that when you're looking at the liquidity from a US GAAP perspective. But even if you do take a look at a SOTA report and you are able to see the fair market value or an imputed fair market value based on, let's say, a swap on Uniswap, you're still also, there's a pretty significant tax liability that folks don't really think about when they just do the math of saying, I've got 1 billion tokens at $2 a token. It's not $2 billion. There's a liquidity discount, there is a tax liability, and you know, there isn't one there's not one answer, not one ray of light. There's just a lot of different things you have to be thinking about when you think about treasury. And I think also, wasn't going to get into this, but you get 5 crypto CFOs in a room and you ask them what treasury means to them, you're going to get 9 different answers. And it's, I think the goal of SOTA really was, let's put everything in one place, whether it is you're using different wallets as for operations, for potentially employee incentives. You can pull from it as you will, but it's all in one place, and it's easy to disseminate.
Any other questions?
Question for I've got one.
Okay, you on stage.
So either maybe show of hands, but how many of you are involved with projects that either have a token or have a token that might be coming up? What's, when you think about that process, I guess I'd love to hear what keeps people up at night. And one thing that we are seeing a lot of, especially I realize I'm veering off of the subject here, but in terms of accounting, but making sure that your TGE is handled properly. Just in terms of timing, when you start thinking about a token project, when do you really begin to roll your sleeves up and include the attorneys, your tax professionals, and other commercial advisors? 6 months out? Hands? 4 months out? Perfect, good answer. But minimum is 4 months, and I think also when you start thinking about, again, ultimately, and I think this gets back a little bit to what Chris was saying, how is this going to be impacting your P&L? How is this going to be impacting, ultimately, where is this going to be sitting on your balance sheet? And especially if there's a foundation that's involved. Again, I think the clarity that you want to get to, especially with SOTA, is really highly focused on just putting it all on one piece of paper, having it all in one place.